The 2024 Banking with Life Client Only event is coming up this October, Friday the 25th, Saturday the 26th. I'm excited to see you, excited to share the news with you.
How many people were there last year?
A little over 130.
How many states?
22 to 23.
Yeah. Okay. So
Right.
the only kind of event where you've got the minority, really the minority, right? Y'all see what's going on social media and online with how IBC and the language of banking is being used. You know that what you're doing is different, and there is one opportunity in the year to go hang out with a bunch of other people who are all doing something very similar. I don't think you should miss it.
You shouldn't miss it. I mean, it's going to be full of educational talks. Breakfast, lunch. The details will be forthcoming in an email. Gives you the opportunity to register. And so I don't want to get deep into the details, but I'm telling you, a room full of like-minded people that are not ashamed to be paying premium, actually controlling the banking function. And last year, Ryan, we had clients that were maybe a month or two, brand new clients, and clients that were 10 or 12 years practicing.
Yeah.
So there's a broad array of people from all over the country doing different things, but they're all focused on controlling the banking function in their life properly, correctly.
Yeah.
And that's exciting. That's a big deal. I don't know where you can go and find that many people in one room.
Yeah. And had the opportunity to hear directly from number one, number two, senior executive leadership at a company that a lot of our clients own. In what other domain of finance today does that ever happen? And nobody go and meet the head of some index fund, okay, or the guys who write up the 401k plans. But you get that here. You hear directly from the people who work at and are in charge of the companies themselves. You meet other people, like you said, brand new clients, people who've been doing it for over a decade. None of this. Look, there's plenty of places. You want to go do the crypto, you want to go do the real estate investing, and go into the new flashy, fun things that are really great to sell you right down a river. There's a lot of that out there. People have a lot of opportunity to go do that. This is not that. It's a nice little break from that. If you were there last year, the venue was very nice. It's a great time to be in Texas in October. I enjoyed it. It'll be a good time.
Ryan's book will be out. The opportunity to get it autographed. Other new merch. Now, I'm looking forward to it. The first one, this will be the third one. The first one was really good. 100 people there, 20 different states. More people were there last year in the second one, more states. I think this one is going to be bigger and better, regardless of how many people come. I'm excited about the talks and the people talking. Yeah. The team will be there. You'll be able to get to meet them. I know most of you have. A lot of you have met them, and all of our clients have spoken with them. But to be able to meet them it's a great opportunity.
Former podcast guests, they come.
Oh yeah.
And so it's for clients of James Neathery and for my clients. And again, details will be in the email. Sign up will be through email. Last time we had a lot of questions about where's the link? It'll be provided by email. Okay, there is no public page because it's not for the public. It'll be sent directly to you. All right.
Yeah, the only agents that'll be there there will be zero outside agents, but there are agents that are affiliated with my office, and they'll be there and their clients. Yeah. And it's not a sales fest. It's not come and see the next great thing to, be pressured into purchasing before you have a birthday or whatever.
Right.
That's pretty cool. Calm, cool, relaxed, and educational and fun. Yeah. Did I mention fun? Yeah, it'll be fun. I assure you. Okay. Hope to see you there.
See you there.
In this episode, Ryan and I talk about lessons from client interactions, and we discuss the impact of financial crises on your personal monetary system. We had fun. Hope you enjoy listening. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
I'm your co-host, Ryan Griggs.
It's been a minute, Mr. Griggs, since you sat here, and I appreciate you making the drive down here.
My pleasure. Rockwall County to Johnson County in 55 minutes on a Saturday morning. Not bad.
That's pretty good.
Yeah.
What is it on a...
Like a weekday?
Yeah,
an hour and 45?
Yeah. What about if they have construction?
Is it possible? I don't know. You go down to Austin and come back up.
Yeah. So I was asking Mr. Griggs, you have any topics? He said, no. It's perfect. All right. Nothing scripted. We didn't set up all week long and say, hey, what are we going to talk about? What can we promote and sell? I love it. However, we do have great conversations throughout the week, every week. This week is no different. And I kind of want to bring them up.
Yeah, that makes it easier.
Yeah.
Frequent interaction.
Fresh.
Well, that's a point on its own, actual interaction with clients.
Yeah.
Yeah. Seems like, and I've said before, too, it seems like some just can't wait to get away from the agent or the client interaction.
I was talking to my beautiful wife, Jen, on the back porch, listening to the birds and catching a cool breeze, hoping the coyotes wouldn't drag my dogs off the perimeter. And we were talking about some of the unknowns that really matter within this industry. And specifically, or additionally, specifically too, as these unknowns, as they apply to the infinite banking concept, right? And that came up in our conversation because I was telling her I love speaking with clients, existing clients, prospective clients, and I can't ever see me taking myself out of service. Mm-hmm. I mean, what I do may change a little, or how often I do certain things may change. But every time I speak to a client, another agent that I'm helping or working with, prospective clients, I mean, things come up that it's like, oh my gosh, mm-hmm. this is so good, Mr. Neathery. You should write a book. But I'm going to live vicariously through your book. And when we were having that conversation, you were sending some text along the way, and it was I'm just having this conversation live with my beautiful wife, and you're sending, and we're covering a lot of different topics, and all of them are the unknown things that matter. So I thought that was very interesting.
I like to tell stories like client interaction. So this is about a fellow named Sam. And Sam, so here we are, August 2024, right? So Sam acquired a policy earlier this year from a different agent and from a company with which I'm not contracted, but has been around for a long time.
Probably reasons why you're not contracted.
Well, that's one thing to talk about is, what is it that motivates or influences with which company and agent may be contracted? That's a whole topic right there. One of which I actually got into with Sam. And so, we are on maybe our second or third call. I have a series of phone calls. It's a lot of time. I tell people up front, like, if you're wanting fast, get it done quick, I appreciate the time to talk with you, but it's just not going to work. I mean, you'd be better served somewhere else.
Yeah.
It's just going to take longer with me. And you should know that up front. But anyway, part of that interaction. So substantial policy relative to his income. And, the policy's in force. So you'd think a lot of these things would be done, but they weren't. And so as he's been sharing information with me up till just yesterday, shared the actual illustration of the policy we've been discussing, but up till now he's just been conveying details, or as much as he knows about it.
Right.
What
he understands.
Right. And so we've been discussing some of the practical implications. We've talked before on the podcast about the cumulative effect of things like direct recognition, annually renewing term, and loan activity, all together. And And so we've talked through that, right? Like that illustration probably doesn't assume loans, does it?
Of course not.
No, it didn't. Okay. Well, dividends ordinarily go to PUA. PUA buys more death benefit. And of course, I know of this with this particular company, I know that they force the use of annually renewing term to prevent MEC status if the client wants to pay PUA premium. Right?
It's a blended PUA. Blended, the PUA premium. There's PUA, the premium into the PUA. The PUA is blended with an annually renewable term.
Yeah. So there's two levels to that, right? So that is the case. Yes, there is a blended term PUA rider on the policy. And it's also the case that if the individual wants to have a separate PUA rider to pay PUA premium to this policy, that he must have that blended term PUA. You
can't have
policy.
The other without that.
Right. They come together.
And that's really to my knowledge, it's one of the prominent companies within the infinite banking footprint that has the two PUA riders, and they have different names. And they're also the company that says, oh, no, we write more IBC type policies than anyone. We embrace the infinite banking concept.
Yeah.
Yeah.
You ask any company, they're at the front of the line. They're doing the most IBC, right?
They're the most vocal about it.
Yeah, except for that one of the big four that is canceling contracts left and right. But anyway, so I'm talking through this, and I'm like, he didn't fully understand the implications of direct recognition at all in the first place. And in fact, what he doesn't know yet, this is going to come out after I talk to him, but I had not seen this previously, just because I don't spend loads of time looking at illustrations of other people's policies. But this particular one not only is treated with direct recognition, but there's also variable loan rates on the policy loans.
What?
And that's unusual, right? Typically, direct recognition, treated policy, so meaning that if there's a loan outstanding at the end of the policy year, the dividend will be reduced.
They call it the dividend will be adjusted.
Adjusted.
Because it could, possibly, theoretically, adjust up.
Yeah. No.
Yeah. Okay.
So the adjustment's going down. And typically with direct recognition, the loan rates are fixed, which is what I was expecting. But no, the loan rate in this case is adjustable, and it says very clearly that it would be declared the first calendar day of every year going forward. So that was unusual. I don't know if he knows that. We'll find out. But so we did talking through the cumulative effects. He's learning that. He learned that something that you've pointed out here before, that like what he did back in January was paid, the dump in, right? Add a whole bunch of extra PUA year one. And you point out, and with this particular company, this is exactly the case, that PUA expense charge for a year one PUA jumps right through the roof.
We're
just talking about
part of the conversation with my wife this morning.
Oh, really?
And it's like, okay, well, and that kind of tied into a conversation that we had earlier in the week, or maybe it was last week. Mm-hmm. Whenever there's a dump in, right? Get as much in as you possibly can in the first year so you can collateralize it immediately, but you won't be able to pay that big premium in year one beyond, year one. Now, structurally, you can for a shorter period of time, but that's not really I want to take over a debt, or I'm going to buy a piece of property. I'm going to do something like next month. So can I get a policy in force to get this huge premium in there? And then how much can I access, in short order you're just trying to shove a policy in there because there's a lot of reasons that are sold, presented. It sounds good until you know the details and you understand the ramifications of the actions, right? And he won't say, but I will. That particular company is 14% front end load, or first year PUA load. Every company has a load, a charge, an excise, a charge, a PUA charge. Every company, right? And then within the industry, they're typically from about maybe 5%. Most of them are 6 to 15% in the first year. right?
I know the big four are all in the 8 to 10% range.
Well, the big one just did some adjustments earlier in the year, and it's higher in the first year on newly issued policies. Yeah. Wonder why. So they're doing the math. You have rising interest rates coming out of a low interest rate environment. You know, their bond portfolio is paying something. They're committed to this dividend that is oversold in the industry. They can't reduce the dividend because of who they are for what it might, the ramifications it might.
Reputational risk. Yeah.
Absolutely. And so what are they going to do? They're going to massage the numbers behind the scene where you can find, they're not hiding it. It's printed, you know, in your policy that you don't read, and the agent that wrote the policy didn't read either, right? It's in there. So I'm not saying they're nefarious, but I'm not saying their peers have driven snow either. My point is that first, just think about this. The first year dump in. Well, can I pay 10 times the premium? Can I pay 10 times the base premium or whatever the matrix is for the life insurance company? Well, sure you can. Wonder why those companies, not all of them, I wonder why the companies primarily that you can do that with and that are promoted, I wonder why they have such a high first year PUA load.
Yeah.
Okay, I have a $10,000 base. I want to do a 90-10, so I want to put $100,000 in total premium in year one, 90 of it going to the PUA, 10,000 to the base because nobody wants any base. And you've got a 14 or 15% charge on that 90 grand. Oh my goodness. So like all of these things happen in the value. Somebody, some agent, some financial guru, you know, reads Nelson's work, Becoming Your Own Banker, his second book, Building a Warehouse of Wealth, and then comes up, figures out how to illustrate a life insurance policy with the life insurance company's illustration software. That's a hurdle because most of them don't even write their own. And I'm not trying to be harsh on agents. I want to make some points here. Right? With a little passion and in love. Okay. They discover that they can build this beautiful policy that goes cash on cash as soon as possible, and then build an illustration using third-party software that doesn't include things like loans, so therefore doesn't include the dividend adjustment, therefore doesn't include loan repayments, and it's powerful and it's passionate and the math appears to work. So yeah, I want to do that.
Yeah. And the companies are giving to the agent what the companies think the agent wants and what the agent thinks he wants, which is the ability to show higher number sooner, right? Larger cash value earlier. You know, a lot of this talking about the PUA, larger PUA expense charge in year one at most companies, not all, but at most companies. It speaks to this point that the structure language, 1090, you know, the slogans, is so limited. I mean, I've already said in the past that the structure language masks the duration over which you can reasonably expect to pay PUA in a non-MEC fashion.
Yeah, to the consumer, no question. But does duration, the conversation of duration, does that really come up with any depth whatsoever?
No. And that's part of what I'm saying is that the slogan, the structural slogan, citing the proportionality across the different buckets of premium in the first year, sort of necessarily, implicitly, simultaneously focuses attention just on that year.
Right.
And so we just leave out the future. And so, yeah, of course, just like you're saying, no, it's not ever. The idea that the structure of the premium, the proportionality across the various elements, the idea that what's done there could possibly affect the number of years over which that PUA is payable in a non-MEC fashion doesn't even happen. That concept doesn't occur. And so there is no discussion about it.
Right. Because there's an illustration that shows all these future numbers.
Right.
Yeah.
And that's what, look, they use IBC, they use the letters IBC, they may be all affiliated with the same group. And so there's a veneer or an appearance that everybody's doing the same thing. And so what I'm looking at, what's being presented to me by this agent must be what IBC is. And so, yes, because it looks really great in becoming your own banker. Nelson makes a compelling point. Seminar's great. So here's what it is. Here's what it is. Here's how it's presented today. So yes. Yeah.
So then we get to deal with the aftermath cleanup or the corrections or the continuing education or deeper education, which, okay, no problem.
That's interesting though. So you got a guy mid-30s, has a job, well-paying job, doing well in his profession, 5-figure, middle 5-figure year one total premium that he paid 8 months ago, and is now learning all this new information.
Now 5 months later,
about what he bought with
he
all
had to be
that money.
Suspect 3 or 4 months or into it. So a month or two. I mean, he's not going to reach out to you when he discovers that like he might need more information, and then call you that same day, right? So
Yeah.
shortly after the policy is delivered, he's then discovers that.
Yeah, enthusiastic, keeps listening, eventually finds the people who aren't as visible from a marketing standpoint as some of these other operations. And they're not, don't get me wrong, they're not all bad. I mean, there's guys out there doing good work. I'm not saying that, but the most visible ones are the ones who prioritize visibility. I mean, this is not like a nefarious type of art. I mean, this is if that's their focus, that's their focus. Yeah. And as you and I had discussed, these carriers just can't help but circulate the production from all the other agents. So you see how many policies or how many lives, and you see the total premium for these other companies. For these other agents,
some more unknowns that really might not matter, it all matters.
Yeah,
different ways.
I opt out of all that stuff. Like, you don't need to be putting my name around anything. A young lady at a company we work with, did an email blast and had, just right in the CC line. I'm like, listen, my dear, next time you blind that or send that to me. I don't need everybody out there knowing who I'm talking to.
Keep my name out of your mouth.
But so you see it, and as you and I were talking about with a couple of these, it's like just arithmetically, just looking at, hundreds of lives, hundreds of policies per month. It's like there are no practical circumstances imaginable where with that quantity, you're doing a very high quality advisory and strategic job
Cannot
with
happen.
every person.
Will not
it's
happen.
not happening.
Not happening.
Yeah.
But then, hundreds a month. I mean, when you get through the math on that, it wasn't really that.
It wasn't. Yes. You start peeling back the layers like, oh.
But then we continue to peel back the layers, and it's like, oh, well, how do they count premium? How do they count lives? And you'd think it'd be straightforward and everybody would do the same thing. No, they don't.
Just like the numbers aren't straightforward on a lot of these illustrations, the numbers aren't straightforward on all this internal reporting stuff.
No wonder life insurance has a bad, reputation.
The insurance companies earn, like you've said, they earn every bit.
And the agents help them. I mean, the agents, oh my gosh, we've all earned the rewards we have coming. Right.
I found that conversations like this one often start with, when someone comes to the process and, tells me that they already own other policies from other agents, which is fine. I don't,
Yep.
Everyone has a past. And they tell me what they've got. The question that prompts this is typically, I wonder, can you and I, me and the client, talk about how to best use the policy that I've already, or the policies that I've already got.
Yeah.
And typically what that question means is, can you help me understand what it is I already own? Because if you know what's going on, you'll know what to do. So if you don't know what to do, maybe you don't know what's going on. And that's not a dig. It's just it applies to me as much as it does to anybody else. If it's not clear how best to optimally utilize what you've got, well, maybe it's just not clear what it is you've got. And so, which is fine. I mean, and so we do that. I do enforce policy reviews. That's one of the conversations.
Sorry.
Well, yeah, among many. I mean, there's so much to cover with people that you can't cover everything, because I'll talk to in-force client, right? People who have policies, have had them for a few months, and they're just finding out about, the use of convertible term and why that might be a good idea. And, you kind of hear in their voice, it's like, well, yeah, this is a great idea. Why didn't you tell me about it earlier? It's like, well, we did have 10 hours of conversation. So it's like, not going to cover everything.
Well, you're never going to get to hundreds of policies a month spending 10 hours per conversation. So your life insurance companies are going to be, encouraging you to do something different. Look, and go on about this one case because...
Yeah, so he's learning all these new things, and we're correcting some misinterpretations. He's under the impression that, he could just pay extra in PUA over and above what he regarded as the maximum to the policy, and it's been a bit of a conceptual challenge to convey that, no, look, every policy, every single one, has a maximum PUA premium. Like, the underwriter must know how much at most you could pay because
it buys additional death benefit.
You're buying death benefit. You're increasing the liability of the company. They need to know about that. So it's not that for whatever reason there was the implication, or he walked with the implication that he could just add more to this. And in fact, that tracks with a separate question actually regarding the truck example that you did on that video from many years ago, right? So this is a separate gentleman I'm talking to, and we're approaching the application time. He says, oh, I have this question. I saw this video with James, and James says, you can buy anytime someone is telling me what you've said, I kind of brace for impact, because it's like, did we understand everything he said? Like, was it all in context, or did we just pull in one line and saying, not maliciously, just, people hear a thing and it sticks in their head and they think, well, I can do that. So he goes, James said, it's what you can do is just buy a policy as a place to put money. And so you could just put money in the future.
Is that me oversimplifying again, right?
Well, I mean...
That's exactly what that policy was for. And, okay, keep going.
But there were layers to it, right? It's like, look, absolutely, the base and the term rider premium, they have to be paid.
Yeah.
So it's not like I can buy a storage bin from Walmart and not put anything in it that day, right? And just put something in it when I have a need to store something. Like, that's not the case, right? Like, you've got to start when the policy's issued, the initial modal premium, initial scheduled premium is due. And that's at least base, and if there's term rider premium. And maybe there's some PUA in there too if the company requires PUA to be paid at a modal interval. So you're paying right now. So it's not like just an empty bucket you can just fill in. And then as I'm talking, I'm remembering, it's like, yes, I know what company that policy was from. I know there was a catch-up provision on that policy. I know what the terms and conditions of that catch-up provision were. And I know that you had sufficient capacity to pay PUA premium between what was annually allowed that year plus what you were permitted to catch up from in prior years, such that you had a place to put money. Like, okay, if we checked all those boxes leading up to, hey, can I just buy a policy for a place to put money? It's like, well, yes, in a sense, but also no, in a sense. I mean,
it's conditional.
Right.
Right. I'm glad you brought that up, because I don't know when that was released. That was a recording of a presentation that I did in front of a room full of agents. Not really sure where that room full of agents, but
was it a real estate thing? Were you at a real estate conference, or was this at a?
No, I think it was another. I think it was at at a well-known group within the Infinite Banking footprint, I believe, but I could be wrong. And I still have the truck, and I still have the policy, right? And I still write for the company that was and I don't promote companies on purpose. And that one really should be redone. But let me say one more thing before I continue. I talk to a lot of agents, more than I want to sometimes, like many of you, right? And some are nice, some are not. I want to help everyone that I possibly can. It's been a difficult challenge for me over my life to learn that I can't help everyone, right? But I don't know of another agent, right? And I'm not pigeonholing you into just an agent. But when we first met, because Nelson called me and said, hey, I want you to speak to this young man. I think somebody called you independently, but they knew Nelson. And did David call you or Bob? I don't know who. I
think it was David.
Okay.
Yeah.
So it was almost like a concerted effort, right, to pair us together. And you, before we actually met, correct me if I'm wrong here, anywhere along the way, you were in Lubbock. I'm in Fort Worth, 20 miles south of Fort Worth, Texas. And we had at least one conversation, maybe a couple. You came down. The second time you heard Nelson, he didn't give a seminar. He did it like an open mic here. But you had watched, how many of my videos that were released at that time had you watched?
As many as I could, because when we were, the timeline between when we were paired and when you had Nelson was very short.
Okay.
So I was in the process of going through whatever was available at that time.
Okay.
Which at that time, there was nowhere near the amount that's there now.
Yeah. Well, in short order, I recall, my memory is you watched every video that you were able to watch.
Yeah.
In depth. Okay. So I don't know. There's a lot out there. There was a lot out there back then. There's a lot out there now before you, the consumer, the individual that's considering buying a policy, adopting this idea. There's a lot of information out there available at no cost. And my encouragement is to watch a lot of it, right? Decipher, see. You will be able to spot the noise, in my opinion. And so that's my encouragement. But on that truck video, it needs to be redone, right? Because the catch-up provision has changed on that. I did so many things wrong on that policy, right? I still have it today.
I'm glad you say that, because like with Sam and this policy we've been talking about, I told him, because he should know, it's like you can 1035 exchange this. You can like swap it out, but I don't think you need to. Right. And it was not something that I'm like trying to angle to get him to do.
No.
It was more about, and I told him about my experience. I have a policy from a Big Four company, one that I worked for 2 weeks back in 2017.
I tried to buy it. He wouldn't sell it to me.
So I still have it. And just like you're saying with that truck one, so many things wrong. It'll only accept base premium now ongoing into the future. And it's what? 2024, 7 years old. So yeah, lots of things.
And that was the best the agent with the Big Four could offer him.
Right.
That was that was beyond their ability, their limitations of understanding and experience. Right. That policy went beyond that agent's experience, knowledge, understanding of life insurance.
Yeah.
Right. And then still beyond her ability, and no disrespect to the young lady at all.
Yeah, just coming out of left field, someone who's been
but
basically
then it's still only limited to 7 years.
Right. Yeah. No term rider. So there was no advisory. It was, she was an order taker.
You told her what you wanted.
I was giving instructions, and I didn't know any better. Right. So I kept it, and I still have it. So it's the same sort of situation. This isn't to make people feel bad per se, but it is to tell them what they have, have a better awareness of what they own, and therefore what they might want to do in the future. When
earlier you said along the lines whenever someone asks, hey, can you help me to use my existing policy best or better? And, that was another way of saying, can you help me understand what I have? Very often, it's that type of question, and it could be an or, do I need to replace these? Can I just move these with you? Do I need to start over? Do I need to essentially 1035 exchange this policy? I mean, that question, when people discover that maybe they know more than they did when they first started buying life insurance, and maybe they would like to do better, will you help me understand what I have and how to use it to the best of its ability? Or the question is, do I need to replace this policy? I see that an awful lot. And then it's bringing them up to the understanding or helping them understand what they have beyond just conversation, right? I know there's very broad terms thrown about, but helping them understand what their policy can do, what they can do, and what they cannot do with their particular policy, and the result of their actions, either way, right? And then when you know what's going on, you'll know what to do. So I'm glad you brought up that replacement.
Yeah, and so he'll end up keeping it. But a connected one, talking about going back to premium structure. This has come to mind in these kinds of conversations. It's like, the industry is starting to figure out what the results of that is like. And there's that one of the big four out there in Massachusetts that is probably the most publicly antagonistic or hostile towards anything remotely
that kind of marketing,
to quote unquote banking.
Yeah, in the first memorandum, what do you call that?
Memorandum. Yeah,
is that what it was? In their first memorandum of last year, they slash everything, but they did not use the terminology infinite banking concept. They didn't use the trademark and the service marks that Nelson Nash or David own. Right. They used all of the other language. And God bless them.
Well,
God bless them.
They
should clean their own house. Pull this log out of your own eye before you pull the speck out of mine.
Well, they're starting to discover that, because we've had conversations with representatives from other companies too, where you get the same sort of impression that and it's very similar to like the criteria that I use to evaluate, we use to evaluate life insurance companies and policies. There's the independent effect. There's, like, for instance, there's what direct recognition or non-direct recognition is on its own, right? And then there's what happens when you start to put things together, direct recognition, annually renewing term, loan activity. They have the compound effect of these different individual elements together has its own unique effect on the nature of the future cash value growth pattern. It's just like that, right? It's like when you start to see these, it's not just that the marketing pitch is for a certain policy or a certain premium design, right? There's often other things that tend to go with it, right? Anti-base, so very low base, very high PUA, very high early cash value. Plus, also, you don't make your money in the policy, you make your money outside the policy. And one way to feel better about that big year one premium outlay is the follow-up encouragement or plan that, a week or two after you've paid it, you're going to turn right around and get a big old loan and go do whatever it is you were going to do anyway, right? So it's on net, your liquidity doesn't change much, right? So that big premium is okay. And, this has an air of cleverness, of sophistication. It sounds kind of appealing. The numbers on the page are big. I get all that. So all of these independent things, premium design, policy, loan, use strategies, and then maybe the person promoting, advertising this approach, maybe they've also got a real specialization in short-term real estate rentals or whatever the other
notes,
investment,
cryptocurrencies,
whatever the other,
maybe all of them.
Just so
choose. We'll bring we'll bring the experts in to show you what to invest in.
Right, for a price. I mean, there's probably subscription. Fee
probably
there.
The circle, the intercircle, the circle. I have my own words for it, but
Master Ultra Titanium Vault. I mean, all the
the vault. I love that.
All the different words.
The deep secrets, right?
Yes, super special. Locked away. So you get in the special locked away area, and you now have this. Okay, so it's a whole.
That's where you find the Dead Sea Scrolls. Right?
So it's a whole apparatus. There's this cumulative type of thing. Okay. So then I say, we'll review all that, kind of understand that from that view, and then say, all right, now let's consider where we are in the business cycle.
What? You mean the business cycle was even considered? What?
Well, and that's kind of low hanging fruit, right? I point that out. I'm like, that part never comes up, right? We never talk about that because, except for a few old timers, most of us haven't been in the business long enough to have experienced the prior major financial correction in '08. And so there's no institutional memory to use
2001.
The very,
I know. Look, I gotta say, when I first, I got licensed in like 1991 permanently. You can get temporary license still today. Back then, they were very common because of all the multi-level marketing, like, A.L. Williams stuff, by term and this, whatever. They would, it's multi-level marketing. So you recruit all your friends and family and anybody who can fog a mirror. You get them licensed temporarily, right? Because they're not going to make it anyway. But I did 2 different temporary licenses. I don't think there's even a limit that how many you can have, but I think they're good for like 6 months, what have you. I was writing Medicare supplements before they were standardized. I know I'm a fossil. I get it. But in 1991, I was permanently licensed and have been licensed and practicing since. Oh my gosh, my point to speaking to the old fossil or whatever. I had a point to that.
It'll come back to you in the meantime.
Here, let me interrupt you and then lose my thought.
Yeah. Welcome to my life, listeners. No, I'm kidding.
Whatever. Oh my gosh.
But so that my point was that the industry is starting to discover that this business features low persistency. And okay, so what's the connection to the business cycle? Well,
that's what it was, the business cycle.
Even outside, how convenient. Yeah. Even outside. So, you follow this direction, pay the big premium, a lot of which goes to PUA, dump in, whatever you want to call it, big early cash value, take the policy loan, go out and do the investments. That policy is now heavily or even maximally loaned out, we call it, right? All of the available cash value to be collateralized, or a substantial majority of it has in fact been collateralized, such that there's not a lot of remaining uncollateralized cash value in the policy. Right? There's not a lot of remaining available loan value, which is what it is. And you can print that out on the page and it can look fine. But when you go to the strategic practical implications, like, okay, well, what happens now when anything goes wrong, something you did or something you didn't do, maybe something the market did, right? I refer to the class of just income disruptions. Maybe they're more temporary in nature. Maybe they're more permanent and severe in nature. Who knows? But one example impetus of a income disruption is the business cycle, because all sorts of things cascade throughout the structure of production. And when banks stop lending, who knows what happens to different parts of the economy and therefore to the incomes enjoyed by policy owners. Well, what happens then, right? What happens when there's an income disruption due to something outside of one's control, like a flagrant change in the rate of growth in the money supply, which was reflected in yield curves, which was then reflected in the financial status of highly leveraged firms that are traded in the stock market. And suddenly all that goes to a moment of crisis, and the available premium source on that policy goes away, or the available loan repayment source goes away. right? What happened? Or maybe both the premium source and the source of the loan repayment go away. Or maybe they don't go away entirely, but they go away significantly, right? For an unknown period of time. What happens then? What happens then? Well, what happens then is that the policy at worst eventually will lapse, right? A rising compounding loan balance, once it equals and then exceeds the cash value, will terminate. And if that happens before the time where cash value exceeds the cost basis, right? So if it happens fairly early in the life of the contract, there probably won't be a taxable event, right? You'll just lose money and the policy. But if it happens later on in life, where the total loan distributions that you've taken up to the point of lapse, where that total amount exceeds, and where the cost basis exceeds the cash value, well, now that loan amount received less your cost basis is taxable. Well, that's news to a lot of people. And you know, one thing, and I got to say this because we're going back to Sam here for just a moment, talking about things that are not readily, you know, some companies sell this thing called an overloan protection rider, right? Which is supposed to be, company X has an overloan protection rider.
Helps one feel good about stretching out that loan as long as possible,
right?
Maximizing the loan as much as possible. Oh, you have an overloan protection.
I'm not going to hurt myself because I have an overloan protection rider. If the cash value does, and if the outstanding loan balance does in fact exceed the cash value and the policy lapses, well, I have an overloan protection rider and it's free. It's complimentary. Okay. I'm going to read to you a paragraph from the illustration of this policy, which has this ostensibly wonderful rider. Okay. Neither the IRS nor the courts have ruled on the tax consequences of exercising this rider. It is possible that the IRS or a court could assert that the policy has been effectively terminated and that the outstanding loan balance could be treated as a distribution, all or a portion of which could be taxable when the rider is exercised. In addition, this overloan protection rider may not be appropriate for your particular circumstances. Consult with a tax professional regarding the risks associated with exercising this rider. The risks, which are, of course, unknown. So yeah, it's so great. You know, the company is going to bake in this way to keep me whole if things get out of hand. Well, yeah. So long as the government doesn't rule about the effects of it.
They're essentially saying that they believe the policy has lapsed, terminated.
Yes.
And that is, so if you have...
Which makes perfect sense.
Of course.
Because that's what happens when the loan balance exceeds the cash value.
Yes.
It's a lapse.
It is a lapse. And the taxable event is in the year of receipt. When that policy lapses and you've had that $500,000 outstanding in loans for umpteen years, everything's going great until it doesn't go great. Then the policy lapses. That's the year of receipt.
Right.
And that's exactly why there's a prominent book out there within the footprint that I will not use.
Right.
Because of that. Not only because of that.
That's a big reason. And then the policy that I've purchased, that I've mentioned on the podcast before, that I bought secondary market from another individual who was misled during the sales process.
What?
It was the same deal, right? Hey, just take loans.
Yeah.
OMG,
I
just
bet they
take loans.
used third-party illustrations that never even took into account the outstanding loan or the interest that it bears.
And then it's exactly what happened. And so lo and behold, 10 years goes by, loan balance is compounding, business circumstances have not gone as originally hoped.
Sure.
Right? I was going to go into business with so-and-so. Turns out that so-and-so, all of this I didn't know. All of this the client didn't know. Turns out so-and-so didn't have the best ethics with the prior business partner and has some legal problems associated with that. And so it doesn't have the capital for us to go into.
Sounds like life in business to me.
Yeah. So the unexpected, I mean, you think I talk in these categorical terms for no reason. The unexpected happens, and then there was an income disruption, right? Or even just a deviation from expectation. This relates to another conversation I've had, because sometimes people get into this vein, and I'm sure I know for a fact you've had this before. I want to go all in. I love this. I want to be my own banker. I want to have as much cash value as possible. I want to pay as much premium as possible. So I want to, right now when I go to apply for this policy, I want to get a big premium, big amount and because I've got, my job's going well. I'm going to earn more. There's a promotion I have in mind. Yeah. And so I had to share this with a young man in New York. I'm like, when we talk about, look, it is possible within the realm of theoretical possibility to design a policy today based on future expected cash flows. And in the very best case, those future expected cash flows would be certain. They'd be, guaranteed. You'd know the amount and you'd know the timing.
Yeah.
Right. You'd have and so maybe that's like something like an annuity. And, if we take a very optimistic view of Social Security, it might be something like that. Right? Contractually guaranteed future income. And within certain limits, we can design a policy today that's built to accept that future stream of cash flow. It exceeds your ability to pay now. Fine. And if all that happened, you would end up better off, right? The policy would have started earlier. It overall would have accepted more premium, cash values, death benefits overall would be greater. But unfortunately, we're on the other side of the garden, right? We don't have a super clear picture oftentimes of upcoming cash flow magnitude and upcoming timing of that cash flow. And it's not always clear when money's coming in the future and how much is going to come in. So my encouragement to this guy was look, especially for the first policy, let's use information we already know. Let's look back. Let's talk about what's already happened, money you've already earned, things that you've already experienced. And let's build based on that. And then if things go uber well, as by the way, statistically, they do, right? As someone gets older, income often rises. Great. We expand the system. That's why you've got multiple policies, why I have multiple policies, why Nelson had 49 of them. Like there's a reason and a time to expand the system and not be over ambitious right from the get-go. And that ties into this approach that we've been talking about too, which is, the find the money. Like let's go find the money so you can have a big premium year one, get you a big policy.
But what do I do? What do I do now?
Yeah.
Is a part of that conversation.
And then going back to this idea that so many things come together, these factors all interplay with one another together. We've talked about the idea of eating up insurability. You're going to go get that big old giant policy that'll accept that huge year one premium. Okay, well, you're going to do it with a boatload of term too. And so there's going to be a lot of death benefit of your limited insurability in force in order to get that done in a non-MEC fashion for right now.
Oh, yeah. I don't know how much pushback I've received on that. And, God bless them. Yeah, look.
What do they say? How do you push back on that? It's like
well, out of ignorance. He says this and this and this, and that's just not true. Well, yes, in fact, it is true.
Yeah.
But it's not my job to go out and correct everybody in the big world or defend myself in they're not even weak arguments. They're like drive-by innuendos.
Yeah. I think I'm going to mention some of this in our Banking with Life live event.
Oh, there's no question. He's going to go deep into this and the correct solution to all of that.
Yeah.
Nonsense.
Show you how to calculate your own maximum insurability.
How to protect it. How to oh my God, they can't give it away now, man.
Oh, there's little hints, little carrots.
It's going to be good. Look, I got to go back, where I interrupted him. He needs to be interrupted from time to time, right? You would do the same thing if you were sitting here. So when I first got licensed in 1991 permanently,
1991. Before I was alive.
There were some old school guys, and I did the buy term and invest the difference, right? So I went to work for a brokerage house, right, that sold term insurance too. That was their whole idea, right? Buy term and invest the difference, or invest the rest, whatever, however A. Williams polluted it or changed it. He took it from them, but that's a very old argument. That argument is over 100 years old. Buy term and invest the difference. Right?
It goes all the way to Solomon Huebner. I mean, if not.
Oh my! I bought a book the other day. I didn't tell you, and I'm all excited about it. But then I bought it off of eBay, right? And then the guy messages me and says, "Oh, this is the right title." So I bought a book that was titled. He mistitled the book, right? And I bought it. He said, "It's this title. Do you still want it?" And I said, "Sure, send it on. I like books, And then I couldn't get past the first chapter. It was all glowing about John Maynard Keynes and Solomon Huebner. And I'm like, oh my gosh, I'm going to get Ryan to read it, right? I'm not interested. Okay, 1991. Buy term and invest the difference. I'm all in. There were some old school guys at that firm at the time that were still licking their wounds from the goes back to the business cycle interruption of 1971 to 1973. So I'm just saying, when I first got permanently licensed, go in and, he's talking about old guys and dinosaurs and all that. There were gentlemen in this office that, they were still dazed by the market correction 20 years earlier, right? So
traumatized.
They were traumatized. Yeah. And, God bless them. They probably took the onus of all of the losses that their clients suffered. I don't know, but I'm surely if they'd have stayed in the market, everything would be great. But I also, too, want to kind of go back some of these conversations about premium, where it goes to the base or the PUA, the general public, the consumer, that's narrowing down. Anytime you narrow down an argument on anything, you're probably weakening your argument. But when it comes to life insurance in particular, the infinite banking footprint, you can live or die on a point all day long. You can live or die on rates. You can live or die on term. You can live or die on PUA, first year premium, or the percentage to the base and the percentage of the PUA. And every time you do that, you're negating so many wonderful, positive, beneficial characteristics of life insurance. Every time. And whenever you have an understanding of the totality of how your policy works, what can you do contractually? What must you do contractually? And then the results of your actions, because you can't take human action out of any of this, right? No discipline. We can talk about it all day long. Just like the policies on that truck example that's been out there for a long time. And I said how many mistakes that I've made and it should be redone. It's actually on our production list to redo it. And the only way I'm going to redo it is comment on it, right? And point out why the mistakes, what the mistakes are, right? So you can't take human action out of it either, but you can act more appropriately in your own self-interest if you understand the contract that you own. And life insurance is a contract. It has requirements. It has limitations. You should understand those, right? And maybe you should understand them, what you can do, what you can't do, and the result of that before you purchase. But I understand that you can wait until you get all the knowledge to make a decision or to take an action, and then you might zoom right past the opportunity to take an action. So it's kind of a two-edged sword there.
Yeah. I wanted to mention here stuff I meant on the subject of the business cycle. One interesting data point to look at is the difference in yield on the 10-year Treasury and the 3-month as traded in the secondary market, which you can find on the St. Louis Federal Reserve FRED data system for free. Yield curve is still inverted, which means the yield on the 3-month is still in excess of the yield on the 10-year. And so the reversion to normal, not inverted time would be when the yield on the 10-year is in excess, is greater than the yield on the 3-month. That would be reversion. And typically, empirically, since World War II, when that reversion happens is very close to around when the National Bureau of Economic Research says that a recession has occurred. Well, if you look at what's been happening with the, how do you spell this guy's name? If you look at what's been happening on that yield curve chart, you'll find that it appears that the yield, what looked like an impending reversion has sort of balanced off, and the yield curve kind of stays inverted. And it's like, why is that happening? Well, for about the last year, you've probably heard the name Nouriel Roubini.
Oh, yeah.
I think he wrote the book Anti-Fragile. He did, and I was on my phone here trying to find the Blockworks YouTube channel where there was an interview about this. But he and a colleague of his discovered that the Treasury, U.S. Department of Treasury, has been offsetting the tightening that the Federal Reserve has been doing. Right, the Federal Reserve has been allowing tens of millions of dollars of mortgage-backed securities and Treasury bonds to mature and to require, repayment rather than just roll them over, right? And this has a tightening effect. Money goes into the Fed, it stops circulating. This is has a decreasing effect on the money supply. Well, as it turns out, simultaneous to doing that for about the last year, so right around where you see that the difference between the 10-year and the 3-month start to not head towards zero, but sort of level off and still that negative space. So that's that tapering off of the reversion that's not yet occurred. What Treasury's been doing for that amount of time is they've departed from their previously established protocols for issuing debt in certain denominations, and have instead been issuing more short-term bonds, right, to increase the supply, to thwart what the Federal Reserve has been doing. So let's see if we can trace that through. So if we're issuing more and more short-term Treasury debt, right, these are the 3-month, 1-year type bonds. We're artificially suppressing the yield, right? Higher supply, lower yield, higher rate. And that's keeping the inversion in place, right? Because the higher yield on the shorter dated debt, what inversion is a higher yield on that shorter dated debt relative to the yield on the longer dated debt. So this move by Treasury to depart from established norms to increase the supply of short-dated treasuries relative to what they had been doing is keeping the yield curve inverted, right? It's preventing that reversion. And back to this more general business cycle, like state of the economy type thinking, you think about what that happens. Like if the Treasury is now providing more liquidity in the form of short-term Treasury debt to the market, it's that short-term Treasury, it's the short-term debt that keeps the wheels on the car, right? That keeps the boom, quote unquote, from turning to the bus. Reversion
from happening.
Right, right.
Correction, yeah, the wheels come off the car. Yeah,
so the whole point of that is that there are these outside factors beyond just the Federal Reserve that have kept the severe correction from happening. Now, go ahead and add a little layer of political thinking to that. Why might they want that to be the case? Like, why wouldn't the current sitting president or administration, why might they want to postpone a severe correction? Why might that be the case? And then you could ask the next question, okay, well, then are all these efforts to postpone the correction going to last forever? Are they always going to do it? Or are they doing it tactically, say, for political reasons? I'll let you determine which one you think might be more reasonable. What I take away from all of that is that business cycles are cyclical. The correction will come when the elite who control these processes have determined that it's politically convenient, and then it'll come. Right? I'm of the view that the whole fractional reserve banking system, the Cantillon effects that come with it, the relative impoverishment of late recipients of new money, the relative enrichment of politically connected first recipients of new money, I'm of the view that all that's on purpose. Other people may or may not be. But what follows from all of this is that I think the crises moments are also on purpose, right? Like there's
what?
It's not. You don't have to believe that if you want. Read a lot of Murray Rothbard and see if you agree or not. You don't have to agree or not. The fact is the business cycles, as I said, business cycles are cyclical. They do happen. Point being, the cycles are coming, and I may not have been in the business. I may not have graduated high school back in 2008, but with an economically informed, and you'd think being in the financial profession, maybe you'd have an interest in economics. I don't know. It seems to be like an
so full of grace this morning.
It seems to be an unpopular view.
Economics? What does that have to do with selling life insurance, Ryan? What does banking have to do with selling life insurance?
Just give me the keywords. So one might think, and this is a longer version of what I have shared with some of these clients recently about this whole overall approach, going back to this idea that all these factors come together. Okay, so you paid the big old year one dump in premium to build the big old cash value. You took the big old policy loan. You subscribed to the Clever investment newsletter. You're heavily or even maximally loaned out. Maybe you made all that decision. Maybe you made all those decisions based on expectations regarding future upcoming cash flow. Markets always go up, right? None of this was the whole business cycle stuff. Everything I went through was not part of the advisory conversation in the first place. And then maybe I'm right, and maybe others. I'm not like something special, right? Maybe others are saying similar. Others are saying similar things. We might look at Bob Murphy or who. Nothing special to me, but maybe a correction does come, and then the source for the premium decreases or goes away, right? Income disruption or source of the policy loan repayment goes away. And then the policy lapses. What then? And I think the industry, the companies, like we mentioned earlier, they're already starting to get suspicious about this disproportionately high loan activity on certain kinds of policies associated with certain agents. They're starting to worry about the lack of loan repayment on those policies, to the point that, and we can say this for sure because we were told about it firsthand, to the point of investigating the marketing and sales practices of certain agents to determine what could possibly be leading to the failure to repay loans. And then you have other companies who don't really care, right? They just see the disproportionately high loan activity and can put two and two together and think, oh yeah, that's going to result in relatively greater lapse activity. And so they're just separating themselves from it, as a rule. That's the Massachusetts company and others. The industry as a whole is going to get a wake-up call.
Another one.
And how many people want to be a part of that? How, you want to be at the front of that line because you jumped on the clever, highly visible, sponsored, paid marketing activity? We're in
the cycle. They're just extending the cycle. And
yes.
Which tells me, shockingly, number one, I'm not shocked that there's manipulations going on. Nope. Who's shocked about that? No one. But you do have time. You have more time than you would have had they not been manipulated.
Hey, who knows? This is pre-recorded.
Yeah. All right. Let me share a particular case. All right, since you like to share cases, and I love them. I'm not going to disclose anything. He would come on himself and share this if he were in a clear, better state of mind. Okay. Have a client 3 years into the policy, substantial premiums, and he's been building capital, right? And I think he's done, one short-term kind of business loan from the life insurance company, collateralizing his policy. And I know he did one loan previous to that just to understand the functionality and the timing, of a loan and loan repayment. And yep, he paid interest for that education and he was happy to do so. Okay. Very successful in business, very successful, historically very successful, but it's also a very niche market, his business, right? And successful investment history. He collateralizes, he takes most of his liquidity to make an investment with partners good investment and they had some knowledge of it, and there was no reasonable expectation of it not working out close to what they expected, right? So he didn't just blindly do it. He's done very successful investments previously. I'm not getting into the nature of the investment. It was legitimate. But oh my gosh, it didn't work out. And and this has happened over, several months. That happened last year. It's confirmed there'll be zero return of his money.
Ooh.
All right. Not foregoing the return on his money. He's facing and foregoing zero return of his money, which caused other issues. All right. And so he's got a policy, right? And he's, I have an advisory, we have an advisor, we have a philosophy, and he's been doing that. This is your tier 1 capital, this is your reserve. It's not meant to have every loan or every dollar collateralized in a loan, which I've seen that in social media. Every dollar of cash value should be collateralized. That is BS, and I'm being nice. That is so BS. When somebody says that, they don't know what they're talking about, and they haven't done that, and they don't do that. If they do that, they've only been doing it for a short period of time. Okay.
Yeah.
So we have a conversation, James, because whenever you do business with me in my office, you get us, right? We come with, have service, ongoing, consultations. And anyway, he's like, James, how do I, this is what I'm thinking, this is what I'm doing, what do you think? So this is what happens when the business cycle turns. And it just started turning within his industry. So the investment went bad in his particular industry. That has had a correction. And a lot of industries have had corrections in the first quarter of this year, right? Okay. And still not a good turnaround. So the investment return is zero. And he was really over leveraged to the maximum point of leveraging, no question. In my opinion, a little bit over leveraged, right? Then his business takes an adjustment in their industry's little business cycle. So he's forced, right, to collateralize, do a cash out refi, primary property, at a higher interest rate environment. So his payments double, right? And now things can change, right? His business cycle can change. He's done well through life. He can pull out more. He can sell other assets and do what, he still has it's not to the point where it's a complete meltdown yet, right? But it's getting close. And then you look at the action of a policy that's properly designed 3 years into it. And he has the means to pay the premium not maximally, but do a significant loan and continue paying the premium and doing the significant loan for several years before it burns down. So
and keep the structure alive.
Right? And of course, he's, I say middle-aged, he's relatively young, but children, college expenses ahead of all of these things, that most of us are going to enjoy in our life. The expenses, right? Now, and my point here is that's what happens. Things outside of his control. He did all the due diligence, all the vetting that he could, going in business with people that he was familiar with and knew, and the deal still went bad. Interest rates are up, right? Now he's got to refinance an asset at double the rate, right? Okay, but he still has a life insurance policy that can eke it out, and we've got it where if he ekes it out, he's going to be fine. If he can't eke it out, we have a solution, a legitimate solution, right? That he can recover. And if he has to burn it down, how do you properly burn things down? How do you walk away with as much intact as possible, and maintain the ability to rebuild?
To come back and get it.
Yes.
After the fact, if you
because the future's still unknown.
I'm going through exactly that right now too with family.
Oh my gosh.
Southern California policies are lapsing because things just weren't. It doesn't happen often with my clients, but in their case it has.
I mean, it happens in life. But then you look at the type of policies and like the insurance companies, they've been looking at their business, where it's coming from, the stability of that business, the integrity of that business, the duration of that business, right? These life insurance companies don't make money for 6, 7, 8 years. I know it's hard to believe. You market guys, it's like, oh my gosh, worst place ever, whatever. And it's not because they paid all the big commissions either. Oh my gosh. Okay. So they're looking at it. Some of them they don't want it. Some of them hadn't wanted it since the 70s, there's not a lot new in the life insurance business and the activities of the agents and advisors. And I'm not being disparaging. I'm just conveying my experience. Now interest rates are going to go up. All right. They're going to go up. Another factor that wasn't considered when all of this glowing plan was laid out. Maximum premium, first year dump in, 10, 20 times the premium, whatever you can get by the underwriters, using up all the insurability. Oh, wait a minute. If they were going to have to burn that down, they couldn't put an exit strategy in place while that's still in place. I mean, there's so many factors that are really, they're unknown things that matter. Okay. When interest rates go up on these policies that are over collateralized, even if you have an over loan provision, go ahead and read it, and that's where that direct recognition company with a fixed interest rate changes their interest rate on that over loan provision. Go figure. They already know that thing is going to become a MEC. That's why the language is in there, because when it does become a MEC, you, the policy owner, aren't going to be able to say, hey, it wasn't a MEC. We didn't know. Yeah, you did. The fully disclosed right there. So, and then
what a good point. Rising policy loan interest rates could increase the rate at which that compounding happens in the future.
It's going to happen. We're coming out of a 15, 20-year interest rate low. The people at the home offices and the life insurance companies haven't experienced it. It's like the old dinosaur that goes to work. It's like Mr. Griggs wasn't even born in 2008. Well, he sure as hell wasn't born in 2000, right? In 2003, most of the advisors in business at that time had never experienced a market correction. When I show up, the guys are still licking their wounds from 20 years earlier, business cycle correction in the 70s.
Yeah.
Like, okay, so we have a history of this. So are we all going to act like we're impervious? It's not going to happen to me. My case is different. I'm the exception. No, I'm going to get the deal done before it all collapses. Really? Okay. And then, Ryan, in his graceful, loving way, I don't know how many times I've talked about simplicity, the simplisticness of infinite banking concept. We had a conversation a couple of weeks ago. It's like, no, this is really not simple. So, I'm like, okay, well, maybe, I've tried to oversimplify it. And I really have not ever tried to dumb things down, ever. Now, I have tried to simplify things, like, pay a premium. It reminds me, it all goes back. So you have all of this exotic presentation, all these exotic things you can do. And when they work, you win. I get it. And the alternative, I don't know what to do. Of course, you might not know what to do. The future is unknown. Even if you have a clear path today and things change, what then? The idea that Nelson said, think long range. How simple is that? It's pretty simple, but it's heavy. It's deep. You got to get through it.
I mean, just that, think long range. If one's going to abide by that necessarily means thinking about business cycles. Because when do business cycles happen? Over the long run.
Exactly on time, when it's the best time for you in your life, right? Yeah. They always occur right on cue.
Yeah. So I think that a reasonable argument could be made that if you're going to do IBC, you're going to go do the infinite banking concept as the guy who came up with that term talked about, and you're going to follow one of his primary 4 and then later 5 rules of think long range. To my mind, that means to be consistent, you've got to start thinking about business cycles and what the effect is in relation to your revenue or income generation and what the effect therefore could be on the policies. And not only should you, the policy owner, be thinking about it, but so should the agent or the advisor. Because, they're
not thinking past next week.
And it'll be a practitioner.
I love you agents that are doing things right. You guys that aren't doing things right, go home, do something different. Do something else. Okay?
Yeah.
I'm encouraging.
The practitioner, someone who's supposed to have more expertise on this subject than the customer or the client, should be talking about this. It's of the things that could go wrong, the effects of a business cycle with respect to availability of income and therefore the premium and the loan repayment source is front and center. Or at least it should be. And so if someone is going through a whole sales process to buy a policy of this kind of design, and that never comes up, it's like, well, I mean, to me, it's like part of professionalism. You go take a nice trip on a boat or whatever. There's the little safety seminar ahead of time. Like, hey, here's the life jackets. Like, here's what to do if things go wrong.
The lifeboats are 3 decks up and 2 decks over. I hope you make it.
Here's what to do if things go wrong. Like, that's part of what it means to operate professionally. Doesn't it? I mean, think about what you do in your profession. Don't you have to be aware of things that could go wrong and what the reasons for those things may be? And don't you have to account for those things, like in how you set up your operating procedures and then your day-to-day actions in the present? Yeah, I think so. So it's like, it's so strange to me that talking about economics is like eye roll or like eyes glaze over, like, they fall asleep talking about it. It's like, this is so weird. There's so much of this is just so weird.
Not only the business cycles, I mean, what is long range to you? Maybe different than it is to me, than it is to Ryan. Right? Maybe you have children, grandchildren. Maybe you don't. Maybe you don't want them. I don't know, but maybe you have things that you give to. You're altruistic. What is long range? It's different for a 20-year-old or a 1-year-old, your prospective client there, than it is a 70-year-old with no children, right? So duration matters. Long range matters to you specifically, right? But it still needs to be considered in the face of the unknown future. Well, then don't be afraid to pay a premium. If I have to access, i.e. get out, quote unquote, as much as I possibly can, I am afraid to pay a premium. It's a continuation of flawed thinking. And then, okay, I'm afraid to pay a premium. I mean, I get that, but then maybe you're thinking too big. I don't know. Maybe you shouldn't try to front load it. I don't know. But it's still an outgrowth or continuation of flawed thinking.
Yeah, let me say, to tune your thinking to your own financial circumstances for the purpose of selecting a total annual premium outlay and a premium structure is a fundamental part of an advisory conversation. Like, if you're not confident in how you're thinking about premium, either structurally or in terms of the amount, that is, in some sense, it's okay. I mean, that is what one should be talking about with an agent, with someone who understands the degree of flexibility and the terms and conditions of the features of a contract available to you. Because that'll affect this part too, right? We can think about the predictability and likelihood of our own cash flow and the degree of variation in that, the degree of cyclicality if we're in something that's more closely linked to sales or to buying and selling property. But on the company side, all of these different policies from the different companies have different degrees of flexibility. The way that the PUA minimum is determined varies across these companies.
when is it payable?
When is it the timing of those allowed payments, the degree to which you can catch up with this with this particular policy. The minimum is about 50% of the maximum. That's pretty high relative to what's also available, right? The timing, the payments, the PUA payments that are made have to be paid monthly, automatic interval, right? Not of an equal, unchanging amount, right? So you can't just pay whenever you want. Okay, well, a higher minimum and the requirement of a regularity in the timing of the payments will affect what total premium amount you might decide to pay. If more of what you decide to pay is strictly regulated and you have to conform with the timing and the amounts, you have less flexibility. Well, when there is an income disruption, not if, but when there's an income disruption, well, now you've got less wiggle room, right? There's fewer ways to keep things up and running without losing features that you might want in the future when the income resumes. Okay. And what are those terms and conditions? Well, all the different companies have different ones, and they have different ones now. And then they change in the future. So even if we talked about specifics on policy like we have today, to some degree, that's all well and good for illustrative purposes, but it's going to change. Just like you said earlier with respect to the policy with the truck.
New policies issued will change.
Right.
Yeah.
New policies for the future. The nature of the catch-up provisions change, and now we've got this company doing both direct recognition and variable loan rates. That's pretty new, at least to me. Like, this stuff changes, so it's got to be talked through. And if it's just the drive-through window of here's your policy, I was going through Starbucks the other day. I couldn't believe this.
You like all the chemicals?
Stop it. I go up to the window, get the coffee. I like to test. I don't want the sweetener, right? So I test it and I'm, getting out of the app and taking not any major rush.
High maintenance right there.
As I'm going through the process, the lady goes, "Did you need anything else?" And I'm like, "No, I just like to make sure." She's like, "Oh, okay, because we got a timer on the window." I'm like, "Oh, you have a time. I need to move so that your time quota can be met."
Velocity, baby.
Like, oh, okay,
noted. Gotta sell another cup of coffee.
Yeah. Okay. So if that's my life insurance purchasing experience, where it's like, "Hey, come on, sign, let's go, like, move it on." Those kinds of conversations that I think are necessary for a coherent and nuanced, robust, secure, conservative type strategy with respect to these policies. If that doesn't happen, well, that's a problem. I mean, things could be better, right? Things could be better. And that's, in some sense, that's what I'm talking about here. It's like all we're doing is our best to optimize and calibrate on the margin, right? Take the next best step. Like I said with this policy, it's not like I'm telling the guy to burn it down. I haven't burned down the policy I got back in 2016 and I keep paying the premium. They're still whole life companies. They've still been around forever. They're still paying dividends. I can still take policy loans. Cash value still goes up to some degree. All right. It's a lot better than a lot of the different alternatives, no question. But, now we're talking about, well, how do we make it as best as possible given what's available on the market? And to some degree, like, whether or not it's the best, just understanding what it is we're buying. Like, just that, right? Like, whether or not I could have got a better TV, and I recently got a TV, whether or not I could have got a better TV, it's like, yeah, that's an interesting question on its own. But how about just to start, I just develop an understanding of what it is I'm buying, right? And start there. And then I can decide if I want to do something else.
I mean, just imagine buying something and continually putting money into it and believing it operates one way, and then some period of time, it's really a blessing for these individuals to discover sooner, in my opinion, than later.
Right? Oh, yeah.
But I talked to a lady a nice lady the other day. She had a 25-year policy. She's like, well, shouldn't we replace it? And I'm like, no, of course not.
Oh my gosh.
But then, you talk to someone.
Do you want to sell it?
That same company that, you're mentioning, you're not mentioning the company that you're describing, talking about. Why would I want to get coverage on all my grandchildren, right? Which is a challenge in and of itself with all the guidelines that exist in the life insurance industry. Let's say I have 7 or 8 of them. And I want to, do what is best. And I understand that this is best because of the great presentation, the beautiful soul that had the interaction with. But I can only pay premium for 6, 7, or 8 years on children. I mean, it makes no sense to me.
Yeah.
No, there's no choice. That's it. So you're going to force them into going into underwriting, go through all those guidelines again. And that's just one example on children. This is an example on an older gentleman. I mean, it is best, of course. If you know what you can do and what you can't do with what you own. I mean, that's simple to me.
Yeah.
That's very simple to me. And so whenever we use broad terms, and I'm guilty of using broad terms, there's no question about that. I want I want to know what my contractual obligations are. And then I want to know what my contractual rights are. Right? And then the result of my actions, whichever I choose, to pay the minimum required or X number of dollars in premium, or to pay this X number of dollars in premium within one contract that you own, right? Knowing the perimeters of that policy and not just in premium. When you talk about the PUA and the blended PUA and the catch up, and you don't have to get lost in the weeds and become a life insurance expert. I'm not encouraging that, or, I don't want to make you feel like you can't do anything until you become an expert in life insurance. These are not complicated. These writers are really not complicated. Now, can you get complicated with the math and the life insurance? Yeah.
A life insurance attorney will describe them in a way that will make it seem extraordinarily complicated.
In every industry, so it is very simple. For you to understand, in my opinion, the concept, right? If the concept makes sense, you understand it to the degree in which you can participate and implement it in your life if you choose to do so, then it's understanding maybe who you work with, right? Who you choose to work with matters. What office you choose to work with matters, because indirectly they're going to bring to you the companies that they want you to engage with.
Yeah.
The companies matter. They're going to propose to you the particular structure or product, or a particular product, and then the particular structure, and the riders or not. They matter. These things matter.
And as we've mentioned before, all life insurance companies, they had their way. Each company's sales force, their agents associated with that company, would only sell the products of that one company.
Oh, yeah.
Right? They all want exclusivity. And you got the ones with the big marketing budgets who can require exclusivity, and they're the ones we call captive. But even the independent ones, they all would really love for you to just work with them, right? And that's true across the board, right? The commission structures are built that way. The more you produce, the more you're paid.
Yeah.
The way the vice presidents interact or attempt to interact with the agents, all the same. Just come over here to it. We're the best. Focus it all here. So I'm telling you that just to say that is the nature of the landscape for everybody. And so you're not going to encounter people who have contracts with all the companies. Right? It's not going to, and maybe there's a big old brokerage house, and maybe, I don't know if they exist somewhere, but maybe hypothetically.
IMOs exist.
Yeah. So it could have, and it only happens at that extraordinarily high volume level because all of these companies have minimum production requirements. Right? So again, part of the incentive structure to focus with one company. Now I'm contracted with 3. I don't know how many is it 3?
With infinite banking, dividend paying whole life with mutual companies.
Other relationships. So, I mean, there are multiple, right? Because there are times where
I'm contracted with everyone that I want to be contracted with. And there's a reason that I'm not contracted with the ones I'm not contracted
Right. And this lines up with the conversation I had with Sam. He asked me if I was contracted with this particular company we've been talking about. And I said, no, I'm not. I don't really see a reason to. And for all the reasons we've talked about, like I see a better solution somewhere else. And so that's where I focus, and I have others in case that even then something else is required. We have another option. But yeah, no. I mean, good for them. They can do what they want. I don't have to be associated. But no. And this is why. So I just want the listener to understand why that is the case, right? That's the structure of this industry. And so given that, like, what do you do about it? Given that, rather than go around and beat up everybody to, investigate, because you're going to be, hard-nosed, I'm going to get to the bottom of it. Show me the data, all that. I mean, do as much as you want. Don't do it with me, but do as much as you want.
Do it with them, not him.
No, I'm just suggesting the thought that establishing a set of criteria that may be important is going to help you sort through all of that. Right? That's why the 5 criteria video that I have on YouTube is there. Meet Nelson's first 2 rules. Once you do that, if you want to add some criteria.
You're being professional, Mr. Griggs, when you not do sorting for them. You've done sorting for yourself, narrowly defined who you engage to work with contractually.
Right.
Right. Well, that matters. I'm just saying that's. Don't tell me you just woke up one day and said, I'm going to pick this company, and this company.
Well, when we first, let's really get it. So when we first met, you had established relationships with companies. And that was my first, outside of that initial Big 4 company that I previously worked for, that was really my only foray into understanding for the first time the nature of these contractual relationships with companies. And what I didn't want is to just say, okay, well, that's the status quo. He's contracted with X and Y and Z. So that's who I'll be, and no thought to it, right? It's got to be, well, like, why? What's the...
right. And can you imagine Mr. Griggs saying, why?
And some of it you and I discussed directly.
Very deeply, yeah.
Other things, I'm going off and looking at what literature they make available and having my own cards. So investigating for myself, like, okay, well, how do I craft my own thinking? Because I, as someone who's entering the business, I'm thinking, well, what do I say to the hypothetical client who says, well, why this company and not that one? Like, if I'm challenged, what am I going to say? And I need to have a good reason. So you go and investigate the reasons, and so, yeah, we work with the same companies, but that's not just because that's what was. It's because you dig into the underlying reasons why. And so I tell people when we get on the phone directly, because I don't discuss companies publicly, because I'm not paid to market for life insurance companies, and companies change and all the reasons we've talked about before. But when I go to tell people, look, we can walk through the criteria, but hey, the punchline here is I prefer X, Y, and Z in that order. Right? That's the punchline. That's where we're going. I'm not trying to blow smoke up your skirt. That's where we're going. But here's the reasons.
Right.
And then here's some examples along the way. And here's what other people are doing. And, they may have their reasons, and we can speculate about what their reasons are. It's beside the point, but that's what they're doing. And that's what the landscape is. Now that's why I tell people, like, the idea in the advisory conversation is to create a more high resolution understanding, high resolution image of the landscape. Get a better map, right? And then once you got the map, look, I'm saying, hey, I'm over here on the map. And here's how you get here from where you are. You can come along if you like, but here's the rest of the map. This is why other people are doing it. And by the way, other parts of that map are very highly well advertised. So you've heard about them before, right? But now they're surrounded by the woods, or you got to, jump through rivers or whatever. Now you have a better understanding of what that will look like. And if you want to go do it. Fine. I'm a believer in, I don't have to be committed to a promotion or persuasion or trying to get you to do something, because I have a lot of confidence in what Nelson said, which is if you know what's going on, you'll know what to do. And I find the reasons compelling for myself, my own premium payment, my own personal monetary system. And it seems to be compelling with other people. And it's not been, the elements of that have not really changed, and they're not well challenged. And what little barbs or slogans or whatever it is out there about, oh, he doesn't understand. Of course I got to mention on my mechanic series, because like I don't know, moron or something, I let comments be out. I could go back and change my mind on that. But one of these little snarky commenters on Reddit. Maybe the fourth. This is on YouTube.
Oh, okay.
On the mechanic series.
Okay.
Is talking. I made the point somewhere. Maybe it was somewhere where I'm talking about the volume of interest versus the loan rate, and I say at one point somewhere that with a policy loan, even with the higher nominal rate relative to the advertised rate on a conventional instrument, the volume of interest is on the policy loan is likely to still be less than the volume of interest on the conventional debt, even when the conventional debt has the lower nominal rate, because of the way loan rate regimes are structured across the two environments. And this, I'm not going to use bad words, but this.
He was an amateur,
very confident person, yeah,
financial expert, whatever.
Clearly went and pulled up a present valuation and loan and interest rate calculator online, zero of which are designed to handle policy loan rate repayment, right? They all assume, with respect to unstructured credit instruments, monthly compounding, and they all assume that the way that the nominal loan rate is expressed is in terms of APR. All of them, okay? So little Mr. Clever Fancy Pants does that little analysis and is like, well, what an idiot. This guy's
with
such
authority, right?
How stupid, Obviously, if the loan rate is higher on the policy loan than it is on the APR, well, then this will result in X amount of interest dollars for the policy loan and Y amount of interest dollars for the conventional debt, and Y is less than X. And so this guy, these guys obviously don't understand how interest works. So cute. And then another one of these losers follows up and says, he's only 29. He doesn't know. He's getting better. There are other, and then my favorite, there are other channels where you can go and learn more, right? It's like, this is the bottom. I can't even see the bottom of the barrel because they're covering it, There's little things like that, but all this is to say that you've got to reflect for yourself. So I've left the stupid comments up. I don't know, maybe I'll delete them.
Did you leave the one that says, well, he gets paid to sell the life insurance? So
yeah,
that's why he can't do the math. Oh my God.
I got to leave
PhD economist student here. Okay, you can't do the math. Well, you don't know about simple you don't know interest. Oh my gosh.
Yeah. What are you going to do? So I'll leave it up. Let the little, I don't know. I'll get mad and take it down. Who knows?
Yeah, who knows? I don't know.
But yeah, those are my notes from the battlefield here recently. Any other cases pop out to mind to you?
We
could probably talk about this forever.
I should write a whole book on cases, but I like the cases that win. In my heart of hearts, this guy can win. I know he can win, and I believe he's going to win. The individual that bad decision, those are in hindsight most of the time, right? When it comes, nobody purposely loses money, or makes bad investments. I get that. But in my heart of hearts, I believe he's going to be able to win. He's going to be able to pull it through. Not just because he has a life insurance policy either, right? Not just because, he's my client or we have a relationship. It's because he's an astute businessman and he's been through some tough times and he's recovered, and I believe he'll recover again. And so I believe he'll be a winning case. And those are the cases that I really like. It is difficult sometimes when, as you kind of alluded to earlier very directly, that when people come at you and challenging you here, this and this, and the challenge is typically based on a misunderstanding. They've heard whatever they've heard that is it should be out there for comparison, right? I get it. But whenever you hear things and you hear them, I hear them, your clients hear them, my clients hear them, and you can just take as much out as you'd like. These loans do not have to be repaid.
Yeah.
Verbatim.
Yeah.
And then they all have the little designations and the recognition of, apparently these groups that mean something and gives them validity, over and over and over. What do you mean I have to make the loan repayment? Oh, okay. Then Nelson, I'll default to simplicity, right? Don't steal the peace, right? Don't not repay a loan, right? Nelson's third.
Yeah.
Right? Don't steal the peace.
We've talked about business cycles. If you think of the alternative perspective of the downturn in a business cycle as to a well-capitalized person, a recession or a depression is a buying opportunity. That's a sale. That's a blue light special. And so it's really, when you think of if I'm putting myself out there as, I'm paying all these social media companies to tell everybody how great of a financial mastermind I am. And my clever approach is to pay a big premium, build a bunch of cash value, go turn around, take a maximum policy loan on the eve of a major correction. It's like, it's the same thing. It's the same genre, different subgenre of the Wall Street view, which is,
absolutely,
hey, you don't need to be capitalized.
No.
You need to go give the control of your money to other people, and you really need to do it as soon as possible. And if you don't, well, you're just being kind of stupid.
Yeah, and then we're going to focus on the rate of return and the low fees. Right. That's all. We're gonna focus on 1 or 2 points, right? Well, we've got the longest track record with the highest rate of return, average rate of return, not actual. And then, we have such low fees. It's like, you got to boil it down to really define, chosen, cherry-picked points.
Right in the box.
Let everything else go.
Yeah.
Yeah.
I mean, how silly is that, right? Because it's the opposite of what you want, right? You'd want to be very well be able to get to as much money as possible at the time when prices are lowest. I mean, that should be obvious, right? It's almost as if a really great investment strategy is a really great capitalization strategy. Because if you were really well capitalized and these business cycles, which tend to be cycles, happen and you can get to a bunch of money, it's, the shooting fish in a barrel image comes to mind.
Yeah.
But who's going to talk about that, right? That's a bunch of unseen future stuff. Can't put a number on that. Can't put it like Nelson talks about with the illustrations, can't put that number on the graph.
I think that's exactly what we talk about over and over and over and over and over. A premium. Premium is the solution. Systematic, on purpose, with intent, capital formation. All life is going to happen, period. The cycles, everything in life is a cycle. All of those are going to continue your whole life. The solution is capital accumulation, capital formation with as much control as possible.
Yeah.
And then,
which is why it's in whole life.
Exactly. So I think that we talk about these things over and over and over, why we refuse to get into what should I do with the policy values now. Watch them grow until it becomes very apparent.
Enjoy the rise.
Yeah. Okay, well, that was fun. And
that was fun.
I enjoyed that.
Thanks for listening. Y'all have a good day. Bye.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.